Morning, whichever time you're watching this clip, please focus, watch carefully, and please download the document that was uploaded to the various website that you should go to, meaning Moodle, and then you get the hard copy. But watch the video and listen carefully, please. Now we're going to look at budgeting at this time, which is Unit 6 on your course outline. For those of you who are following, it says budgeting. A budget is a plan. A budget is a plan usually expressed in monetary terms. To make meaningful decisions about the future, a manager must look ahead. One way to look ahead is to prepare a budget or forecast. A forecast may very well be simple, ain't it? Right? A forecast may very well be simple, may be very well simple. For a restaurant or own operator, the budget might be no more than looking ahead to tomorrow, estimating how many customers will eat in the restaurant, and purchasing food and supplies to accommodate this need. By contrast, in a large organization, a budget might entail forecasts up to 5 years, such as for furniture and equipment purchases, as well as requiring day-to-day budgets, such as staff scheduling. Budgets not expressed in monetary terms could involve numbers of customers to be served, number of rooms to be occupied, number of employees required, or some other unit as opposed to what? Dollars. Or look at the purposes of budgeting now. The three main purposes of budgeting can be summarized as follows. One, to provide organized estimates of future unit sales revenue, expenses, net income. Of what? The operative term is what? Future, right? Future unit sales revenue, expenses, net income, staffing requirements, or equipment needs, broken down by operating period and department. Alright. Next purpose is to provide management with long-term and short-term goals. These goals can be used to plan future activities. Next purpose is to provide a method of control so that actual results can be evaluated against budgeted plans and adjustments if necessary and can be made. Now we look at types of budgets now. There are a number of different kinds of budgets. This section describes long-term and short-term budgets, capital budgets, operating budgets, department budgets, and master budgets. Now we look at the first type, which is look at long-term as compared to short-term, right? Budgets can generally be considered to be either long-term or short-term. A long-term budget would be anywhere from 1 year to 5 years ahead. Such a budget concerns the major plans for organization, creation of a new market, financing, or other related matters, and are often called what? Strategic budget. So, under the name for a long-term budget would be what? Strategic budget. So, and this for what? 1 to 5 years. From such a long-term budget plans, or from such long-term budget plans evolve the policies concerning the day-to-day operations of a business, and thus the short-term what? Budget. So, short-term budgets come from long-term budget. Now, a short-term budget now could be for a week, a day, a quarter, or a year. Such budgets involve middle management in using its resources to meet objectives of the long-term plans. Then we look at fixed versus what? Flexible budgets. Remember, so, all right. Now, a fixed budget now is based on a certain level of activity or sales revenue. Expenses estimates are based on this level of sales. No is made to introduce greater or lesser levels of sales revenue, and thus different expense amounts in what? The budget. This is the disadvantage of a fixed budget or such a budget is that if the actual sales level differs from the budgeted sales level, there is no plan covering this possibility, and expenses can only then be adjusted in the short run by what? Guesswork. There was no plan for it. For example, suppose the rooms department budgeted in a hotel is based on the average year round rooms occupancy of 70%. That is the all right operating costs. If, for example, payroll supplies, linen and laundry are based on this level of occupancy, right? So the operating costs are based on the 70%, right? If actual occupancy drop to 60% because of unforeseen economic conditions, it might be difficult for the rooms department manager to what? Know in the short run what the new payroll level what should be because with a what fixed budget. Alright. So what is happening here is that they are planning to pay the people based on what? 70% capacity. Now what if it falls 60% capacity? That means you have less guests, less money coming in. So how you gonna pay the people then? You won't be able to pay them. Alright. Next look at now is flexible or variable budget, right? A flexible or variable budget is prepared based on several levels of activity. In our rooms department example, sales revenue could be forecast for 60%, 70%, and 80% occupancy levels for as many levels as are appropriate. As the actual year progresses, it can be determined at which level the operation is going to fit best, and the appropriate expense levels will have already been determined for this level. In other words, adjustment is easier because the budget was for what? 60%, 70%, and what? 80%. The question could be raised then, using the rooms department example, as to whether it is truly flexible, as whether, as to whether it is truly flexible or variable budgeting, or whether it is three. Or more if more occupancy levels are used. So fixed budgets are three different occupancy levels, right? So whether it is three now question they ask, the question could be raised using the room department example, as whether it is truly flexible budgeting or whether it is what? Three different fixed budgets, right? At three different what? Occupancy levels. 60%, 70%, 80%. The question is valid, but the practical result is that management is prepared to adjust to the actual situation when adjustment is what? Required. With flexible with flexible budgeting, variable expenses will change with the volume of sales, but fixed expenses will what? Remain the same. Again, with flexible budgeting, variable expenses will what? Change with the volume of sales, but fixed expenses what? Will remain the same. So the more sales, expenses might increase as well. Alright? For example, a budget might be prepared for a restaurant based on a number of levels of sales revenue. Expenses are calculated based on what? Each different revenue level. Variable expenses what? Might be expressed as a percentage of sales revenue or as a dollar amount per unit what? Sold. However, advertising expense might be fixed. Might be a fixed expense and will be left the same regardless of the actual level of sales revenue. In other words, regardless of the volume of sales, a definite fixed amount is budgeted for what? This expense, which is what? Advertising. A really flexible budget would show expenses that are truly variable, with expenses as a percentage of that sales revenue and fixed costs as a what? Dollar amount. We look at capital budgets now. A capital budget is a plan for the acquisition of new or replacement of existing fixed assets. A 5-year replacement schedule for hotel room furnishings is a what? Capital budget. And look at now operating budgets that is, an operating sorry, an operating budget concerns the ongoing projections of revenue and and expense items that affect the income statement. For example, a forecast of sales revenue for a restaurant for a month is in an operating budget. Similarly, in a multi-department hotel, the forecast of total period expense for the year is an what? Operating budget as well. Again, an operating budget concerns the ongoing projections of revenue and expense items that affect what? Income statement. For example, so it is ongoing then, right? For example, a forecast of sales revenue for a restaurant for a month is in an operating budget. Similarly, in a multi-department hotel, the forecast of total period expense for the year is on what? An operating budget. Alright. We look at department budgets now. A department budget would only be of concern to a restaurant complex. In brackets are with, for example, dining room, bar, and banquet areas. Where departmental income statements are prepared, or to a hotel that has a number of what? Departments. A department budget would therefore be for a specific department and would show the forecast revenue less operating expenses for that department. We go again. A department budget would only be of concern to a restaurant complex with, for example, dining room, bar, and banquet areas. Where departmental income statements are prepared or to a hotel that has a number of departments, a department budget would therefore be for a specific department and would show the forecast revenue less operating expenses for that what? For that particular department. Okay? Alternatively, if a department does not directly generate any revenue, example the maintenance department of a hotel, a department budget could be prepared showing anticipated expenses in detail of an operating for an operating period. Generally, such department budgets are prepared annually and broken down what? Month by month. That's about department budgets. Look at this what? Look at this what? Master budget. A master budget now is the most comprehensive of all budgets. Generally, a master budget is prepared for a year and includes a balance sheet for a year. Hence, for a year. Hence, and all the departmental income and expense statements for the what? Next year. It's a master budget. Alright. Thank you for watching.